everyone, welcome back to the course on International Financial Management. In the previous lecture, we built a comprehensive understanding of what country risk is, its definition, its four types, the economic indicators that signal a risky environment, and the tools used to assess it systematically. Today, we complete our treatment of country risk by answering the question that every CFO and investment manager ultimately ask. Now that we have measured the risk, what do we do about it? This is the shift from diagnosis to treatment. And as we will see, managing country risk is not a single action. It is a continuous, multi layered process that begins before a firm even enters a country and continues for as long as it operates there. Before we answer how country risk is managed, it is worth pausing on a prior question. Can it be mitigated at all? The honest answer is not in the way what that transaction exposure or translation exposure can be managed. With transaction exposure, a firm can enter into a forward contract, purchase a currency option, or use a money market hedge. The hedge is simple, clean, precise, and financially separable from the underlying business. But the same does not hold true for country risk. Country risk is too broad. It is too multidimensional. It encompasses political decisions, regulatory actions, social instability, and economic policy, all of which are ultimately expressions of sovereign behavior. But while country risk cannot be eliminated, it can very meaningfully be managed. Firms that invest thoughtfully, structure carefully, and engage actively with the host country environment can substantially reduce both the probability of adverse events and the severity of their consequences if they do occur. The management of country risk happens at two distinct stages. They are before investing and after investing. And here is the important principle of country risk management. If I state it simply, it is the most effective country risk management is proactive, not reactive. Well, what does this mean in practice? It means that the time to manage country risk is not after an adverse event has occurred. It is not after the government has announced a nationalization or not after a political crisis has erupted. By that point, the firm's options are severely limited. It is negotiating from a position of weakness with capital already at risk and leverage largely lost. So what should be the solution? And the solution is proactive management. Now here proactive management means thinking about country risk at the investment decision stage. That is before committing capital, before signing agreement, or before building assets in the ground. It means structuring the investment in a way that reduces exposure from day one. And it means managing the relationship with the host country continuously and deliberately throughout the life of the investment. With that principle established, let us now turn to the first stage of country risk management, and that is called the pre-investment stage. This is when the firm is still in position to negotiate the terms of its entry. It can choose how to structure the investment. It can choose how much to invest, in what form, with whom, and on what contractual basis. This is why pre-investment risk management is so valuable. It deserves careful, systematic attention before any cross border investment decision is finalized. Pre investment management of country risk involves three broad strategic approaches. The first is structuring the investment, that is, deliberately designing the legal, financial, and ownership structure of the investment to reduce exposure to country risk events. The second is international integration. It means linking the subsidiary closely with the company's global network so that it becomes costly for the host country to take action against it. The subsidiary may be part of a global supply chain, so harming it affects many countries and many companies. It may involve foreign investors, lenders, or partners, thus increasing international pressure on the host country. The third is political risk insurance, that is, transferring the financial consequences of residual country risk to a third party insurer. Let us work through each of these in turn. The first structuring strategy is local equity participation. This involves bringing in local equity partners such as individuals, institutions, or government entities from the host country itself as its co investor in the foreign subsidiary. The idea is simple. When citizens or institutions of the host country have a financial stake in the foreign subsidiary, their interests are aligned with the firm's interest. The subsidiary success becomes their success, and government that takes adverse actions against the firm through, let's say, expropriation or regulation or discriminatory taxation, this government also harms its own country's investor. The Maruti Suzuki example is one of the most instructive illustrations of this strategy in the Indian context. When Suzuki sought to enter the Indian automobile market, it structured its investment as a joint venture with the Government of India, creating Maruti Udyog Limited, in which the government held a significant equity stake. This structure was not accidental. It gave the Indian government a direct financial interest in Suzuki's operational success in India. The government was not just a regulator of the firm, it was a co owner, and that fundamentally changed the nature of the relationship. For Suzuki, this structure substantially reduced the risk of adverse regulatory action. For the Indian government, it provided access to Suzuki's technology, manufacturing capability, and management expertise while retaining a stake in the value created. It was, in that sense, a genuinely mutually beneficial arrangement, which is exactly what effective country risk management through local equity should achieve. The second structuring strategy is local currency borrowing. The idea here is to finance as much as of the subsidiary's investment as possible through borrowings from banks and financial institutions within the host country, rather than through equity capital or intercompany loan provided by the parent. This might seem like a purely financial decision, a choice about the capital structure of the subsidiary, but it is simultaneously a country's risk management strategy and a powerful one. The rationale for local borrowing as a country risk management tool operates on multiple levels simultaneously. From the transfer risk perspective, if the subsidiary is funded primarily through local debt, the parent's equity exposure, that is the capital it has at risk in the host country, is smaller. If transfer restrictions are suddenly imposed, there is less parent capital trapped in the country. Now, let's see from the ownership risk perspective. Now, a subsidiary with significant local creditors such as local banks, local bondholders, local financial institutions create a powerful domestic constituency that has a strong interest in opposing expropriation. If the government nationalizes the subsidiary, it does not just harm the foreign parent, it also imposes losses on the local lenders who have lended the money to the subsidiary. From the currency risk perspective, local currency revenues matched with local currency debt reduces the subsidiary's net foreign exchange exposure independently of the parent's position. In short, local borrowing is simultaneously a financial hedging strategy and a political strategy. It embeds the subsidiary into the local financial system in a way that raises the cost to the host government for any adverse action it plans to take. The third and most formal is the ownership structuring strategy. This strategy is the joint venture. A joint venture goes beyond simply having local shareholders. It is a formal arrangement in which the MNC and the local partner, which may be a private company or a state owned enterprise or a government itself, co own and cooperate the foreign subsidiary as a shared enterprise. Both parties contribute capital, share in the profits and losses, and typically share in the governance of the entity. Joint ventures are widely used in high risk or heavily regulated markets, precisely because they offer the risk sharing and the relationship benefits of local equity participations in a more structured and binding form. The Gulf oil industry provides perhaps the most enduring global illustrations of joint ventures as a country risk management tool. Major oil companies operating across the Gulf in Saudi Arabia, Abu Dhabi, Kuwait, and Qatar have historically structured their operations as joint ventures with the state entities. Aramco Partnership, Abu Dhabi National Energy Company arrangements, Qatar Petroleum joint ventures. These are not accidents of history. They reflect a deliberate recognition by both sides that a structure in which the government is a co-owner is far more stable and durable than one in which a purely foreign company extracts a country's natural resources. Moving now to the second broad pre-investment strategy is the international integration. International integration is a powerful and often underappreciated approach of country risk management. Rather than changing the ownership structure of the investment, it changes the strategic position of the subsidiary within the MNC's global network. The idea is to deliberately structure the subsidiary so that it is embedded in the MNC's global production, marketing, and supply chain in a way that makes it genuinely difficult for the host government to act against it without harming its own economy. The first dimension of the international integration is the production integration. Under this approach, the subsidiary is positioned as a critical link in the MNC's global supply chain, producing a specific component or an intermediate product that is essential to the parent's global manufacturing process. Now, if the host government expropriates or shut down the subsidiary, the entire global production process is disrupted, not just for the MNC, but potentially for its customer and supply chain partners around the world. The ripple effects extend well beyond the host country's borders. Now, acting against this subsidiary is no longer a bilateral matter, that is, between the firm and the host government. It becomes a multilateral issue with broader economic consequences. Now, this creates an international pressure that deters the host country to take such kind of actions. The second dimension is marketing integration. Here, the subsidiary serves as the regional sales hub, a distribution center for the MNC's product across a broader geographical area, not just the host country, but neighboring markets as well. If the subsidiary is disrupted, access to the entire regional market is lost. The host country starts to look unreliable for doing business in the region, which harms its reputation and makes it harder to attract future foreign investment. The third dimension is supply integration, where the subsidiary acts as a regional procurement hub, sourcing raw materials or inputs for the MNC's broader network across multiple countries. Now, what does it mean if you disrupt it? That means disrupting supply chains that benefit other countries and other firms, thus creating multilateral economic pressure on the host government. The three dimensions, that is, production, marketing, and supply integration, work together to create a web of interdependencies between the subsidiary and the broader international economy. Even after the most careful pre investment structuring like local equity, local borrowing, joint ventures, and international integration, some residual risk will always remain. No structure can fully eliminate the risk of sovereign action or the host government action. For this residual exposure, firms can turn to the third pre investment strategy, and that is the political risk insurance. Political risk insurance is a mechanism by which the financial consequences of a specified country risk, events such as expropriation, political violence, transfer restrictions, breach of contract by the government, are transferred to an insurer. If the insured event occurs, the insurer compensates the firm for its losses up to the coverage limit. Political risk insurance is available from two broad sources: private insurers and government guarantee agencies. Private insurance is provided by specialist insurers and dedicated political risk underwriters. Private insurers are commercially oriented. They price coverage based on assessed risks of the specific country and investment, and they offer a range of customized coverage types. Government guarantee agencies are operated by home country governments as instruments of trade and investment promotion. They provide political risk coverage, typically at subsidized rates, to their own MNCs investing abroad, with the explicit goal of encouraging outward investment by reducing the risk of cross border capital deployment. Among all the sources of political risk insurance, MIGA, the Multilateral Investment Guarantee Agency, occupies a unique and particularly important position. MEGA is part of World Bank Group, which means it is backed by collective weight of its member governments, that is virtually every country in the world. It provides political risk guarantees to private investors from member countries investing in other member countries, covering risks such as expropriation, transfer restrictions, breach of contract, and political violence. What makes MIGA coverage especially powerful as a deterrent is the institutional consequences it carries for a host government that takes adverse actions against a MIGA insured project. That makes MEGA coverage not just a financial safety net, it is a diplomatic deterrent. The host government knows that acting against a MEGA insured investment carries a far higher cost than acting against an uninsured one, and that knowledge itself reduces the probability of the adverse action occurring. We now have covered the full suite of pre investment strategies. let us turn to the second stage, that is managing country risk after the investment has been made. Once a firm has invested in a foreign country, the nature of the challenge changes fundamentally. It has committed capital, it has built assets in the host country, it has employees whose livelihoods depend on the subsidiaries' continued operation, it has local suppliers and customers who are part of its value chain. In this situation, walking away is not costless. Exit is expensive, disruptive, and may not even be possible quickly. The firm is, in a very real sense, embedded in the host country and it must manage its relationship with that country accordingly. The strategy at this stage therefore shifts from risk prevention to risk mitigation and relationship management. The question is no longer how do we structure the investment to reduce exposure, it is how do we behave, operate, and engage in a way that makes it politically and economically unattractive for the host government to act against us. Post investment country risk management is largely about maintaining what is sometimes called the social and political license to operate. That is, ensuring that the host country, its government, and its people continue to see genuine value in the firm's presence. Four strategies are central to this: the good citizen policy, second, increasing technical contribution, third, negotiation and arbitration, and fourth, localization of management and operations. The most fundamental post investment strategy is the good citizen policy. At its core, this is deliberate, sustained commitment by the MNC to being a responsible, visible, and valued corporate citizens in the host country, to conducting itself not merely as a profit seeking foreign entity, but as a genuine contributor to the country's economic and social development. Its goal is to make the firms politically difficult to target, to build a reputation and a record of positive contribution that raises the cost to any government of taking adverse action against it. The specific action that constitute the good citizen policy include paying taxes fully and transparently, complying fully with local laws and regulations, contributing to local community development, environmental and social responsibility. The second post investment strategy is to continuously increase the subsidiaries' technical contribution to the host country. The greater the technological capability that MNC brings to the host country, the more deeply that capability is integrated into the local economy through training, knowledge transfer, and research and development. And the higher is the cost to the host government of acting against the firm. Why? Because expropriation of technologically sophisticated subsidiary does not just take away the physical assets, the building and machinery, it also loses the operational knowledge, the technical expertise, and the ongoing technological upgrades that only the foreign parent can provide. Despite all of the firm's proactive efforts, host country government may still start imposing new restrictions. It renegotiates an existing agreement on unfavorable terms. It may still signal hostile intent through regulatory actions or public statements. When this happens, the firm's first and most important response should be negotiation, not confrontation. Negotiation, by contrast, keeps the conflict private, keeps the relationship alive, and preserves the possibility of mutually acceptable outcome. This is always preferable both for the firm and in most cases for the host country as well. If negotiation fails, international arbitration provides a structured legal mechanism for resolving the disputes. Three forums are most relevant for investor state disputes: the ICSID, that is, the International Center for Settlement of Investment Disputes, which is a part of World Bank Group. It is primary global forum for disputes between foreign investors and the host country government. Most bilateral investment treaties specify ICSID as default arbitration venue. The next is the ICC, that is the International Chamber of Commerce. International Court of Arbitration is another widely used forum, particularly for commercial disputes that have a country risk dimension. And the last is UNCITRAL, that is the United Nations Commissions on International Trade Law. It provides arbitration rules that are widely incorporated into bilateral investment treaties and can be used in ad hoc arbitration. The fourth post investment strategy is localization, deliberately and systematically increasing the proportion of host country nationals in firms' management structure, workforce, and supply chain. Localization is in many ways the most operational expression of good citizen policy. It is how the firm demonstrates, not just in words, but in actual hiring and procurement decisions, that it is genuinely committed to the host country's economic development and genuinely integrated into its social and economic fabric. Localization operates across four key dimensions. First is local management representation. It involves appointing host countries' nationals to senior roles, including the board. This signals commitment to the local economy and brings valuable political and market insights into decision making. Second is a local workforce strategy, which focuses on employing host country nationals at all levels. This creates jobs and makes firms economically important. Third is the local supply chain integration, meaning sources, inputs, and services from domestic suppliers wherever feasible. This expands the firm's economic footprints and build a network of local stakeholders who benefit from its presence. Fourth is maintaining structured communication with the government and regulatory bodies help build relationship, enabling early detection of policy shifts and reducing uncertainty through proactive engagement. Together, these dimensions strengthen the firm's local presence and relevance, increasing the political cost for government to take adverse action against it and reduce exposure to political risk. The strategies we have examined so far, that is, local equity, joint ventures, good citizenship policy, technical contribution, localization, all share a common orientation. They are collaborative. They assume that the firm can build a relationship with the host country that is mutually beneficial and that provides meaningful protection against the adverse action. But this assumption is not always valid. In some environments, especially genuinely high risk environments, where the host government is demonstrably hostile to foreign investments, where the rule of law is very weak, where the property rights are not reliably enforced, a collaborative orientation may not adequately protect the firm. In these cases, the defensive approach comes into play. It basically refers to a set of strategies that take the opposite orientation. Rather than building relationships and integrating with the host country, the defensive approach is designed to limit the firm's vulnerability by maintaining maximum control and minimum dependence on the host country environment. The defensive approach comprises four specific strategies. Let us go through each one. The first is to maximize debt investment and minimize equity in the subsidiary. Rather than funding the subsidiary through equity capital, which, if the firm is expropriated, is simply lost, the firm tries to finance its financing needs primarily through debt. Debt claims have a higher legal standing than equity claims in insolvency and recovery proceedings. And minimizing equity exposure limits the amount of capital that can be seized by the host country. The second is to minimize the involvement of host country nationals at strategic points in the subsidiary, specifically at positions where they would have access to proprietary technology, sensitive business plans, or financial controls. This reduces the risk that valuable intellectual property or strategic intelligence is lost to the host country if the relationship becomes difficult and the firm is eventually forced to exist. The third is to train and educate host country nationals at the parent's headquarters rather than at the subsidiary office. This fulfills any commitments to develop local talent, which are often required by the host government, without transferring the core knowledge and capability to the host country environment. The training happens in a location that remains firmly under the control of the firm. And the fourth is to concentrate all R&D activities in the home country and never in the foreign subsidiary country. Intellectual property that drives the firm's competitive advantage must remain securely within the home country's legal jurisdiction. If the subsidiary is expropriated, the firm loses the physical assets, but it retains its proprietary technology, its patents, its trade secrets, and capacity to replace the operation elsewhere. It is most important to note that the defensive approach is not the default strategy for most MNC in most environments. It is a strategy calibrated to genuinely high risk situations where the trust in the host government is low. In practice, most MNCs adopt a position somewhere between a fully collaborative and the fully defensive approach, calibrating their degree of local integration and control based on their ongoing assessment of the host country's risk level. And critically, this balance is not fixed. It shifts as country risk conditions evolve. A country that is safe and collaborative today may become more volatile tomorrow, requiring the firm to adjust its strategies. A country that is currently high risk may undergo political change, reforms its institution, and may become more hospitable, allowing the firms to progressively shift towards a more collaborative orientation. Country risk management is therefore not a one time decision at a point of investment, it is a continuous, dynamic process of assessment and adaptation. And that brings us to the end of today's lecture. We covered the full spectrum of country risk management from pre investment structuring to different post investment strategies, contrasting these with the defensive approach for high risk environments. In the coming lectures, we move to new and important dimensions of international financial management, that is, the economic risk and the carriage risk. These build naturally on what we have covered and take our understanding of foreign exchange risk to the next level. I look forward to seeing you there. Thank you.